The topic I'm going to cover today is analysis and interpretation. When I started doing these revision videos, I should have actually apologized for the fact that everything is handwritten here for the answers. I didn't have time to actually type up everything, so I thought rather cover more questions and handwrite them than less questions and type them, if you know what I mean. Okay, the first thing is true and false. Liquidity measures the ability of the business to repay total liabilities using total assets. That's false. The liquidity is current assets is to current liabilities. In other words, whether you can pay back your current liabilities using current assets. A business with a current ratio of 3.5:1 has idle capital. That is true. So the safety level for current ratio should be about 2:1, and you way above that at 3.5:1, which means you've either got too much stock that's not selling, too many debtors that aren't paying you back, too much money sitting in a bank account getting no interest. So that's what we mean by idle capital, capital that's not used effectively. The formula used to calculate markup percentage is gross profit over sales. That is false. It's gross profit over cost of sales. Theft of stock will decrease the markup percentage achieved. That is also false. Theft of stock will not decrease markup percentage because if stock is stolen, you don't record the selling price, nor do you record the cost price, so there's no effect on the formula gross profit over cost of sales. Net working capital equals current assets plus current liabilities. That is false. It's current assets minus current liabilities. Then if salaries increase from 12,000 to 15,000, this is a 20% increase. If you work out a percentage increase, you take the difference, in other words 3,000 here, divided by what it was. So 3,000 over 12,000 is actually 25%. So you don't take 3,000 over 15,000, it's the difference over what the original was. Right, then they give you information taken from the books of Times Square and the business sells watches. They then give you a series of financial indicators and amounts and ask you questions. So before I start going through the questions, when you're doing analysis answers, make sure you answer in point form, and very important, make sure you quote relevant financial indicators or information. Right, the first question. If current liabilities is 140,000, you need to calculate current assets. You need to look for a formula that's got the current assets and current liabilities in it, and that's obviously your current ratio here, which is 2.5:1. So the 2.5:1, your current liabilities are 140,000, so you multiply by 2.5 and you get 350,000. Then you need to calculate trading stock. I'm going to show you a shortcut method here. If you look at your current ratio, the current ratio is all your current assets, your stock, debtors, and cash. Your asset test ratio is just your debtors and cash. In other words, the difference between those two is actually going to be your trading stock. So the quickest thing to do here is to take that current ratio, which includes stock, subtract the asset test ratio, which excludes stock, and you get 1.7, which you then multiply by the current liabilities of 140,000. The next one, the period of stock on hand is suitable. Do you agree? Give 2 reasons for your answer. Okay, if you have a look at the period of stock on hand, it's 95 days, around about 3 months, just over 3 months. Okay, the stock you're selling is watches. Watches are not perishable, they're not going to go off. Those watches are not seasonal. You don't only wear watches during one season of the year. Stock's not going to become out of date within 3 months. So the period of stock on hand is perfectly fine for a business that sells watches. Then if the business wanted to decrease the period of stock on hand but did not want to decrease selling price, there's 2 ways to achieve this. So you can't say give a discount because that is decreasing selling price. You need to try and increase customer awareness of your product, so you could increase advertising. The other thing you could do is try and make sure that you do research on what customers want to buy. So you research customer demand, see the type of watches they want to purchase, and then buy that from the supplier so that you've got the right type of stock on hand that's going to be easy to sell. Okay, the next question. Calculate the following return on average owner's equity. The formula for return on average owner's equity is net profit over average owner's equity. They gave you your net profit figure here. I don't know why this thing is jumping like this. They gave you a net profit of 18,750. They actually gave you average owner's equity. If they didn't, take the owner's equity at the beginning plus the end divided by 2. But this one we can just use the amount that they gave you. So you're going to take that net profit, you're going to divide by the average owner's equity, you get 2.5%. Then they ask you to calculate the annual interest on the fixed deposit, the annual interest rate. If you look here, they tell you that the interest on fixed deposit for 6 months is 2,475. We want the annual rate, so you need to times this by 2 and then use your fixed deposit of 90,000. So the interest times 2 divided by the 90,000 as a percentage, and you get 5.5%. They then ask you whether or not the owner would be satisfied, giving a reason. First of all, no. The reason is because your return here, 2.5%, is below what you could get if you just put your money in the bank. So notice how I am quoting figures here. I said the return, 2.5%, is less than the interest rate, 5.5%. If I wanted to get more, I could sit back, put my money in the bank, and I'd earn more than if I worked really hard at running my business. And then 2 suggestions as how the return could improve. The way you need to increase your return is to increase your net profit. And there are a number of things you could do here. You could decrease your expenses, you could sell more, you could increase your markup and maintain sales level. In other words, sell the same quantity of stock but at a higher price. Then what is meant by the statement that performance of a business is stagnating? If something's stagnating, it's not getting better, nor is it getting any worse. So the business performance is no better or no worse. Then the last one here, the employees of a business are given an annual increase of 3%. In your opinion, would they be satisfied? Give one reason. They won't be satisfied because 3% increase is below the inflation rate. The inflation rate is your cost of living increase. So you're earning a higher salary, but that's actually increasing by less than the price of goods and services increasing in the same time period. Okay, so don't forget then, answer in point form, quote your figures, and one last thing in this, you do get given a data sheet, but they don't tell you the name of the financial indicators, they just give you the formulas. So make sure that you learn what the name is of each of the formulas that you get given. Okay, that's all for now. Thanks.